I think we have peaked temporarily. I mean, first of all, I said that at gold at 3,500 a couple months back. And I wrote, for our premium service that gold would be doing a trading range throughout the summer and possibly longer. And I also said that during that point in time, it would be good to either trade gold for platinum or silver, or if you wanted to add to your positions, add platinum, add silver. And both those metals took off relative to gold. So in other words, gold stayed basically steady state, and both platinum and palladium recently.
In today's news recap, silver in correction mode after the FOMC meeting. Silver has entered a notable correction phase after months of sustained upward momentum. The precious metal has maintained a clear uptrend on higher time frames with consistently higher lows and higher highs, demonstrating resilient strength throughout most of 2024. However, as prices approached the psychologically significant $40 resistance level, selling pressure intensified, triggering the current pullback. The correction phase is most evident on shorter time frames, particularly the 8-hour and 4-hour charts, while the longer-term bullish structure remains intact on weekly and monthly charts. This dichotomy between timeframes creates both challenges and opportunities for traders navigating silver's volatile price action. What we're seeing in silver is a classic technical correction within a broader bull market structure, notes veteran precious metals analyst Mark Thompson. These pullbacks are healthy and often set the stage for the next leg higher once excessive speculation has been cleared from the market. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Have all shot up. However, I think they have hit that point that gold did a few months back, meaning that they are going to establish a range for a while. I think how long, I don't know yet. I haven't seen enough data, but I would just guess it probably through the end of the summer. For example, we're end of July. August is usually the worst month or best month, depending on how you look at it for gold. In other words, usually the cyclical low for gold is established in August. So that's another month out. And then September, the old adage, sell in May and come back after Labor Day. That's usually about the third week of September. So I would guess, from historic precedent, we would see probably all four metals move in a trading range from here, probably for a couple months at a minimum. Obviously, something could hit. But most of the news that's favorable to the metals is already kind of put into the price. And I know everyone's thinking there's very little resistance for silver from, 39 up. But hit 39 briefly, and now it's dropped off about $1, he said. So that's it. Sideways is what I expect. Doesn't mean the bull market's over. It's really healthy for markets to consolidate and build another base and move up. I made that comment on another interview recently. And what you really don't want is a higher price every day, and then you get into a parabolic move. Those are not sustainable. But if you staircase up, you build a base at 32, then it jumps up to 34, and you build a base there, and then it jumps up to 36, and you build a base there. Of course, that's an idealized base because, they go up and down. But basically speaking, if you look at the charts, that's kind of what it looks like, a stair. And those are pretty stable because you have a base, so then you have a support level. Then you move up and you build another support level. So that's what I'm looking at. Yeah, the tariff situation is like playing 21 at Las Vegas. You could keep rolling the dice over and over and coming up with a different number. But on the basis of what you asked me, yeah, I think there's a little more stability, a little more reconciling what these tariffs are really going to look like, and a little more solidity to the proposition that, here's what we're going to do. And you can kind of depend on that. So yeah, I think markets hate instability. They hate the unknown. So even though tariffs might not be suitable to the counterparty that has to pay them. Once they are established and consistent and they know what they're going to be for some, time frame, then the market can kind of, take that in and work with it.
Fidelity says $4,000 gold possible as Fed cuts, dollar drops. Gold could hit $4,000 an ounce by the end of next year as the Federal Reserve cuts rates to cushion the U.S. economy. The dollar drops and central banks keep adding holdings, according to Fidelity International. Multi-asset fund manager Ian Sampson said the firm remained bullish on the precious metal, with some cross-asset portfolios recently increasing holdings as prices eased from an all-time high above $3,500 an ounce in April. The rationale for that was that we saw a clearer path to a more dovish Federal Reserve, Sampson said in an interview, adding that some funds had as much as doubled their 5% allocation over the past year. Also, August is often slightly weaker for markets, so more diversification makes sense, he said. Gold is up by more than a quarter this year as uncertainty around President Donald Trump's aggressive attempts to reshape global trade, conflicts in the Middle East and Ukraine, and central bank accumulation buttressed gains. Still, the metal has traded within a tight range over the past few months, with demand for havens cooling a little as some progress in U.S. trade talks eased fears about worst-case scenarios for the global economy. Fidelity's bullish outlook for gold is similar to that from Goldman Sachs Group Inc., which has made the case in recent quarters for an eventual rally to as much as $4,000 an ounce. Still, others are cautious, including Citigroup Inc., which forecasts weaker prices. Spot bullion was last near $3,315. Now we'll show you the best clips of the latest interview. Don't forget to like, subscribe, and turn on notifications so you do not miss out our daily recaps. And check goldsilverstacks.com to get your Stacker's Handbook, the ultimate guide to stack gold and silver, packed with strategies to trade the gold-silver ratio and get more ounces and build wealth over time, so you don't have to rely on market commentators to make your investment decisions. Enjoy the episode.
Yeah, I think we're at again, that trading range. And that's what I call an indecision pattern. It's kind of equal bulls and equal bears. No one's really winning. The bears win and the market goes down $100. The bulls win and it goes up $100. I'm referring to gold. And that means that just what I said. So what's going to take it to 4,000? Well, the bulls have to win. There has to be more buying pressure than selling pressure. What would cause that? Well, there's a number of things, but most are out there already. The war situation, Middle East, Ukraine hasn't gone away, flare-ups in Pakistan that have cooled off. So all of those things that are really favorable to an increase in gold prices are already there and pretty well known. So what's going to take it to the next level? And that would probably be something in the financial sphere where we have, let's say another bond auction and no one shows up, as an example, where, yields are actually forced higher because demand is nothing. So to sweeten the deal, prices, their yield gets pushed higher. And that's just an idea. I'm not saying that's going to happen. I'm just giving you an example. But I am still of the mindset that it will get there, but maybe not as easily as we went from the 2,000 level, which we finally broke through and hit, 3,500 pretty quickly. I think we're going to need to kind of work this base and then go higher. $500 more is a nice move, but nothing like the $1,500 that we saw from the 2,000 level. Eventually, I think we're going to see even higher than 4,000, but I'm writing a report right now, and depending on the overall global economic climate and what happens in the, I would say, non-reality, the stock market indexes. There's a gentleman that most of our viewers would probably be familiar with, Charles Nenner. And Nenner is very, very bold in his predictions, but he's also very accurate. And for an example, if we went from the high level of the Dow right now down to 5,000, for an example, thought experiment. David, it's never going to happen. I'm not that bold. I don't know the future. And gold made it to 5,000. Well, that would be a very interesting place to contemplate, because many in our peer group talk about the gold-to-Dow ratio. And when the gold-to-Dow ratio hits 1, that's a pretty good sign that we've hit a top in the gold market, or conversely, a bottom in the stock market. I'm not saying that's going to happen. What I'm trying to convey, and I want to convey very strongly, is that the price of gold is what most everyone focuses on. But really, you want the value of gold. And this is something that Mike Maloney does very well. He talks about how much of a house do you get for an ounce of gold, how many barrels of oil, how many bushels of wheat, how much of the Dow Jones Industrial Average. And so if you thought about, let's say, a contraction in the economy and the housing prices came down nationwide, we just use the U.S. for an example, let's say 1/3, the gold went up by that $2,000 or $1,500 from $3,500 to $5,000. So you got that increase in gold, and you got a decrease in the housing market, or maybe the bond market, or the stock market, or the automobile market, which is suffering badly. So you have to look at it in terms of, what do I get for that? So it's not always a function of price. That's what we're taught to think, and we think prices all the time. But really, I think a better and more accurate measure is to look at what it buys in terms of other hard assets.
What do you think of Morgan's take? Do you agree with him? Are you buying more gold and silver at these prices? Or on the contrary, are you selling like most other retails? Post your honest opinion in the comments section down below and share your gold and silver price predictions with the Stacker community. Now check out this next video right here because it's the perfect follow-up for you. I'll see you on the other side.